everyone. Rhonda, thanks for your acknowledgement. Mike and I also pay our respects to Australia's Aboriginal and Torres Strait Islander people, and we hope that the path towards reconciliation continues to be shared and embraced. So before we start, a bit of background as to who CSI is and also our roles within it. I'm Libby Ward-Christie and I'm Principal Industry Fellow with CSI Swinburne. I'm also Director of the Swinburne Social Startup Studio, and I'm presenting today with my colleague, Dr. Mike Moran. He's a Senior Lecturer at CSI Swinburne and also the National Education Director for the CSI Network. So both Mike and I have a particular research interest in impact investment and social finance for social enterprises and other charitable ventures. And what we're presenting today draws on case study and empirical research that we've been conducting in this field. CSI itself is a national research and education centre, and we operate out of 3 partner universities. We produce research that catalyses social change, and we are the leading provider of undergraduate and postgraduate programs in social impact. We aim to build capacity in the social purpose sector and bring people together to create social change. In this webinar, we're discussing a form of social impact investment that we've called impact investment icebergs. In reality, these icebergs are layered impact investment transactions in which different forms of social financing are brought together, usually to fund social enterprises and charitable ventures. You may ask why the iceberg analogy? Well, firstly, as we'll be discussing, it highlights that contrary to both academic and popular opinion, social impact investment is not an homogeneous landscape. These icebergs exist as quite distinct and different forms to their surrounding environment. Secondly, like icebergs, a characteristic of these transactions is the tendency for people to only see and focus and talk about what's above the surface. And finally, we suggest that these types of impact investments are perilous. Whilst we are presenting today with what might seem like a theoretical lens, we're keen to highlight that we believe this work surfaces a really important issue for social enterprise and social impact investment in Australia. It's an issue that, left unacknowledged and unresolved, restricts the further development of both fields. So before we begin, it's important to set some definitional boundaries. Firstly, social impact investment. So whilst this term is to some extent contested, social impact investment has a fairly settled definition. Simply put, it is investments with a social and financial return and measurement of the achievement of both. Social enterprises are typically seen as organisations with the primary objective of creating social or community benefit. They engage in trading activity to achieve this social purpose. So for a social enterprise, the overarching strategic objective is the creation of social value or impact. Unlike commercial business ventures, maximising profits is not the end game objective of social enterprise.
Now, although some find this framework problematic, traditionally impact investment has been explained using this matrix. So on the y-axis, we have financial returns, and on the x-axis, we have social returns. At the lower left quadrant, we have low social impact and low financial returns. Hopefully our investments and our giving will not sit in this quadrant. If we look to the lower right quadrant, we have philanthropy. We'll have no financial return. A grant is a sunk cost, but hopefully a high social impact. Our grant will be impactful, but of course we gain no private benefit. It's purely for public benefit. If we look to the top left quadrant, we can see mainstream investments or finance-only investments that have high financial returns, hopefully, and often low social impact. And this would ordinarily include investments in, say, a managed fund, including responsible investments and others with an environmental, social, and governance overlay. And these are increasingly used, as we know, by asset managers such as superannuation funds. Adjacent to this, we have our impact investments. We have finance first impact investments in which we have financial returns and which are at least market related. These may not be enormous, but they're going to need to meet the requirements of fiduciary or what a prudent or responsible person would deem appropriate. To the right, we have impact first, which the matrix suggests has higher social returns, but there is a compromise. There'll generally be a concessionary or below market return. Now let's take a look at a few examples using the matrix and using the example of environmental finance. If we look to mainstream investments, we may have, say, a managed fund that has an environmental overlay and indirectly invest in companies based on a positive environmental benefit. So it meets two of the criteria of impact investing Libby outlined earlier. It generates a financial return, has an environmental benefit, but it's really a form of responsible investment. There's no measurement. If we extend this example to, say, a renewable energy fund that directly invests in solar and wind projects, and assuming other elements such as measurement in place, it might be characterised as a finance first impact investment. So if we take this a little further and look to the impact first quadrant, we might have a concessionary loan to help finance a wind and solar project. This would constitute an impact first investment. Now, to add a bit of a dimension, we also have layered deals in impact investing, which actually describes the reality of most impact investments, particularly those in not-for-profits and social enterprises. And what we see here is deals where one party or parties receives a market return, such as an institutional investor, another a concessionary or below market return, such as a philanthropist, and another provides a grant, say a gift of land. And all this enables the impact investment to take place. Now, if we look at the size of the market, what we can see here is that we do have a growing field in Australia, and this is particularly so with respect to the availability of capital on the supply side. For instance, the 2018 Benchmarking Impact Investment Report showed that market size of impact investing has actually increased almost fivefold since the first report was released some 2 years earlier. And this report found that investable impact investment product has grown from 1.2 billion in 2015 to 5.8 billion in 2017. Now, what this tells us is there has been positive growth, particularly in that finance first segment. We can see real maturation in finance-led impact investments. And these are often indirect investments, such as, say, a green bond, that win-win segment introduced on the earlier slide. But on the other hand, it really confirms what has been observed by practitioners and researchers anecdotally, stagnation at the impact-led end of the spectrum. And in particular, we've not seen much growth in direct investments. And these are investments that generally support social enterprise, particularly those that take a charitable or not-for-profit form. And again, this was backed up by the Benchmarking Impact Report, which for the first time tried to capture private market activity, including direct investments by Australian charitable trusts and family offices. And this report found commitments of around 43 million, of which only 14 were direct investments.
So if we now cast our gaze to the demand side, there is strong evidence from a variety of sources, including practitioners themselves, that social enterprises struggle to access finance first social impact investment capital despite its relative availability. This is the result of a number of things, but primarily due to the fact that social enterprises exist to create social value or community benefit, not to maximise profits. And as such, there's often a tension between profitability and their social purpose that results in them not being able to afford finance at market rates. And contrary to traditional commercial business paradigms, this is often irrespective of age and scale, because the reality is that there are few economies of scale when it comes to providing support for the people in our communities that are most vulnerable. What we do know about social enterprise is that they are often more financially marginal as a result of the cost of achieving their social purpose. They tend to have, but not always, not-for-profit legal structures and therefore can't access equity capital. But also, this results in directors who are not remunerated for their governance contribution and therefore are more risk averse and less likely to be in a position to provide directors' guarantees, as the risk-reward relationship for them is not the same as it would be in a for-profit context. We also know that most social enterprises are small businesses and therefore are not resourced and equipped to navigate really complex financial deals, and their size and financial marginality often results in relatively few assets on their balance sheets to provide security against financing. So as a result, social enterprises ideally require unsecured, low-cost, patient capital that reflects their achievement of impact. That is, concessionary, impact-led social impact investment, which we know from the previous slide is in poor supply in the Australian market. So as a result, we've seen layered social impact investment transactions emerge as a way that finance-first investors can access deals and social enterprise investees can access some of the capital that they need. In truly entrepreneurial style, social enterprises opportunistically stitch together these complex structures and augment finance-first social impact investment with any available impact-first capital and donation grant capital so that they can access and make affordable the finance-first component. The result is a highly complex, treacherous, far from ideal scenario at both the organisational and ecosystem levels. So Mike and I have been researching these structures for the last couple of years now, and it's evident that layered transactions result in deals that are complex to execute and often conflict-ridden. They often have confused strategic objectives and also communication challenges. So to help us understand why, we're going to turn to a little bit of theory. We've drawn on institutional theory and specifically the idea of institutional logics to try and better understand why the conflict and complexity exists.
Now, in economic sociology and organisational studies, the institutional logics perspective is a framework that's been developed for explaining how the underlying values and beliefs of different actors inform and are informed by their professional background. It begins from a position that society is made up of multiple domains: the state, the market, charity, and so on. And within these fields, people navigate their understanding of the world by way of reference to professional values and beliefs. And this is expressed as different institutional logics. So a typical example would be a financial professional who views the world through a finance or banking lens, or alternatively a social worker who negotiates their world through a social lens. And researchers have begun to explore how this framework applies to understanding impact investment. And I think we can see that the utility of this framework is somewhat self-evident. Social impact investment, at least notionally, brings together market and social logics. Now, this research has tended to show that the logic of impact of finance first, or the supply side, really dominates the field. That is to say that social impact investment has been understood and negotiated through a finance lens, often at the expense of a social or welfare logic. Nonetheless, it's not really explored or adequately accounted for, we believe, for the diversity of the field. And in the case of the layered social impact investment transactions, our work has identified three different institutional logics. The first logic we've identified is that finance and market logic that we see in most finance-first social impact investments. And this is characterised by a desire to generate social impact, the belief that impact invariably positively correlated with profitability. The second logic we've identified is the socially entrepreneurial logic. And this is evident in impact-first social impact investment, and I guess most social enterprises. And this is characterised by a belief that commercial and financial mechanisms are a means to generating social impact, and that profitability and impact are often in tension. And finally, we've identified a third logic, which we describe as a philanthropic logic. And this is evident in charitable trusts and other grant-making institutions that place strong emphasis on social outcomes, coupled with prudent, risk-averse management of the endowment or corpus, and in which opportunities are usually seen diametrically as grant-making or investment. And we can illustrate each of these with some examples from our case-based research. So in this quote you can see on the screen before you, and apologies to those looking on the phone, this will be available later for viewing. In this quote from a finance first impact investor, you can see there's a strong expectation of financial as well as social return, and also the dominance of commercial thinking, and activity is the right way of doing things. We should also note that this is the logic that we tend to see dominating social impact investment in Australia. And this really reflects the broader neoliberal narrative around the superiority of business and market-based approaches. By contrast, this quote from a social enterprise investee illustrates the socially entrepreneurial logic in which there is acknowledgement of commercial business mechanisms, but these are subservient. They're a means to an end to achieve social impact. And finally, this quote from a trustee of a private philanthropic foundation highlights the philanthropic institutional logic. Prudent management of the corpus so as to enable impact through grant making.
So organisations and structures in which different logics are combined are known as hybrids, and there are different forms of hybrids. One way of thinking about these different forms is to consider the degree of compatibility of the varying logics. So in our case, the finance logic, the socially entrepreneurial logic, and the philanthropic logic. And then we couple with this the extent to which these logics are essential to organisational functioning. Whereas you could argue in more traditional impact investments, such as a green bond, there's a high degree of compatibility and alignment between the logics. The conflicts and tensions between the three logics inherent in these layered social impact investment transactions make for low compatibility. And yet at the same time, the relative lack of any other more suitable capital for the investees and an undersupply of suitable deals for the finance first investors heightens the need to bring these incompatible logics together. The result is what is known as a contested hybrid. The name doesn't really matter, but what's important is that layered transactions, like many contested hybrids, often result in conflict in terms of strategic decision-making, power and operationalising, and structuring and resourcing the organisation. They often also struggle to communicate externally and for legitimacy. So in practical terms, these quotes, which again are on the slides for those of you that are dialing in, they'll be available later, are from a failed layered social impact investment transaction. And they highlight the increasingly intractable conflict and the difficulty to retain support and legitimacy that these structures experience. So in these quotes, we see the impact investor looking for a financial return from ventures with a primarily social mission or purpose. But we also see the social enterprise opportunistically pursuing impact investment at the suggestion of their advisor, despite a lack of experience with impact investment, and also having existing systems and processes in place that are designed to access and deliver upon donation grant capital. We also see the advisor reflecting in hindsight that the social enterprise didn't understand the norms and expectations of the impact investment, and the social enterprise also not connecting the dots internally between their financing terms and their operating budgets and activities.
And we also see with social impact investment icebergs that investors and investees often deny their existence. When communicating publicly, many social enterprises tend to highlight the impact investment component of these deals, and many concessional funders don't necessarily appreciate that it is their capital that supports the social enterprise to access the finance first capital in the first place. And we argue that this relates to legitimacy. Investors, particularly institutional investors, seek to strengthen their legitimacy through participation in social investment deals. Philanthropic, concessionary, pro bono and low bono participants arguably seek to strengthen their legitimacy by demonstrating innovation. And social enterprise investees seek to demonstrate the legitimacy as businesses and to some extent their financial nows through accessing non-grant capital and participating in the social investment market. As a result, investors and investees tend to discuss the finance first aspects of their transaction without acknowledging the full structure of the iceberg. So often all that is discussed is that visible section we can see up the top of the transaction, the investment component, often the finance first component, without revealing the underpinning concessionary contributions. So by this we mean that participants emphasise that component which is truly an investment, but do not highlight or acknowledge the other elements which make this deal happen. And that is the grant and below market capital. And we argue that not revealing the full structure of these transactions also reinforces the narrative, the returns and impact can be easily achieved with little or no trade-off. Also, if we continue to paper over the existence of these icebergs in the social impact investment landscape and not acknowledge their full structure, the adverse implications continuing to construct contested hybrids will remain unaddressed, and a less than ideal social finance system will be perpetuated. And perpetuation of a narrative that does not recognise that the undersupply of impact-driven capital is not working for a large segment of organisations that really deliver much of Australia's social impact, namely not-for-profits and social enterprises and other charitable organisations, will continue to stymie the flow of appropriate capital. And we argue that it's important to reveal these icebergs. The social impact ecosystem will be much better served by calling out the role that philanthropic and grant capital and impact-led investments play in enabling a degree of finance-led impact investment. So acknowledging the presence of these icebergs and the challenges they bring. So if there was more impact-led capital, that is appropriate forms of capital that acknowledge the mix and balance of logics required, the system would better serve the needs of not-for-profit social enterprises. Thank you.
Thanks so much, Libby and Mike. I really appreciate that. I'm sure everyone does that very thorough presentation. We're now at the Q&A session. Hi everyone, we can see you now in gallery view. So if you have any questions, feel free to send them through. I haven't actually got any questions yet, so I'm keen to see any. You can put them in the chat box or feel free to put up your hand or make a note if you want to verbally ask your question. That's also okay. Oh, here we go. Thanks, Angela. She's asked the first question. Angela is a regular at our webinars. So she's asked, where do SBIs fit in?
SIBs.
SIBs, sorry. SIBs, where do they fit in?
Mike, do you want to take that one?
I guess one of the things with social impact bonds is that they are generally quite bespoke, so there's a bit of variation on where they sit in. So according to the public and private ancillary fund guidelines, they are seen as a concessionary investment. But what we know from the 70-odd SIBs that have been developed globally is they actually have very high returns. So I think the average return for a SIB is 7 to 12%. So they would actually sit within that finance first segment of the market. And in fact, are quite generally seen as quite a safe deal because they are supported by government. So there's a bit of a moral hazard question there. They're generally not going to let them fail. We actually did do some work on J2SI, which is a social impact investment transaction in Australia, developed by Sacred Heart Mission and the Victorian government. And that was quite a unique model in that it brought in a philanthropic guarantee. So it actually had, it was actually very much a blended and layered transaction and probably sat in that concessionary component. But by and large, SIBs are, whilst they've got very high transaction costs, a lot of professional development costs, and are underpinned by a lot of pro bono work from different participants in their development, they generally have high market returns. So they kind of sit across both fields. Libby, do you want to add anything?
I was just going to add too, in terms of the J2SI transaction, it definitely demonstrated some of those elements of contested hybrids. So highly complex to execute. There were communication challenges. There was difficulty in where to position it within for investees and how it was to be considered. So for the participants in that particular example, it was actually surprising how difficult it was, which we think is partly explained a bit by this contested idea as well, that you had sort of the 3 different logics operating.
Thank you. So we've got lots of questions now. The floodgates have opened. So John, you've put your hand up. Do you want to unmute yourself and ask the question?
Yes, thanks very much. Can you hear me?
Yes.
Beautiful. Mind expanding stuff. Thanks a million, Mike and Libby. My question, so if the problem is with contested hybrids, in part at least, the issue of the lack of clarity and transparency, the solution, as you suggested, is the need to sort of reveal the full structure of layered, blended hybrid type structures. To what extent, in your view, is part of that to do with the way different financial and social interests can be appropriately domiciled or housed within different parts of an overall legal structure? What I mean by that is, you know, sort of the way of structuring a transaction so that there are charitable for-purpose organisations that are part of the ownership structure. Then you might have a for-profit proprietary limited company involved. To what extent is structuring deals like that part of the solution to the problem that you've described?
You want me to go first, Mike?
Yeah, go for it, Libby.
Thanks, John. It's a great question. And in fact, one of our case study examples was exactly that. And I think what we see from that instance in particular is that kind of segmenting structure to enable these kinds of things will still only work if there's strategic and logical alignment, and that it's very, very clear what those different components of the overall organisational business model and how that's manifested in a legal structure, the different roles that they play. So you still will get the conflict in logic occurring if all that those kind of various legal structures and forms to enable different forms of capital are just a response to actually what is an undersupply of appropriate forms of capital in the first place.
Thank you. Thank you.
Thanks so much, John. Okay, I'll direct this one to Mike. So a question from Chris. Do you have some examples of hybrids which you could tell us about? It would seem that the mix is inevitably problematic. For example, anyone giving a grant would see this grant as simply being used to provide a big return to the finance first investors.
As in specific examples from the Australian context, or?
Chris, feel free to unmute if you like.
Yeah, just to illustrate it, Mike, because it would seem sort of fundamentally problematic, other than how you've explained it, separating parts of the business.
I think what you can say in the context, particularly of charitable ventures in Australia, so impact investments in those enterprises that are structured as not-for-profits, virtually all would be considered a layered transaction. So Libby and I do have a slide from another presentation which puts up about 20 odd kind of high profile impact investments. And the vast majority of those actually do have a layered structure and are underpinned from grants. And that goes from everything from Good Start, which is really one of the largest social impact investment transactions, even though it's about 10 years old in Australia, where it had some guarantees in the forms of loans and so forth, right through to say the Street Enterprises deal that Libby was just referring to there, where they set up a hybrid legal structure. So there was the parent entity was the not-for-profit. They set up a PTY Ltd, and in pre-impact investors were able to, they were able to access equity from those investors and so forth. So I think the majority of examples, really, particularly in charitable social ventures, are what are layered deals. Libby, do you want to add anything?
Yeah, totally agree. So I think one of the things that, as we started to look at these structures, that struck us was pretty much every impact investment that we could find into a not-for-profit social enterprise was actually a layered transaction. And one of the things, and one of the reasons we came up with the iceberg analogy, is that they tend to just be talked about as social impact investments, and that has a very particular kind of people assume that that's just a finance first component sitting up on the top of the, at the tip of the iceberg, but actually in every instance we're seeing the layering that's sitting underneath. So, it's probably more the norm than the exception, but it's not talked about in this context.
And I think to add to that is we are seeing a growing impact investment market in Australia, but it's very much in that finance first win-win segment. So indirect investments, so green bonds are the classic example. But the segment that I guess we work with at the more complex end, within not-for-profits, it's very much layered deals. And I guess our argument is that it's not really called out, so to speak. So it's about really acknowledging that, the vast majority of deals in relation to not-for-profit social enterprises are layered and blended.
And we actually saw when the social enterprise development investment funds came on board around 2011 or so, that this layering and structuring was having to happen to get that finance first capital out the door.
Great. Thanks a lot.
Thank you so much, Chris. Another question from Emily. Super interesting presentation. What are your views on the optimal structure of a social enterprise to maximise investment options available? Are these complex blended models effective, or could there be a better way? I'll direct this to Libby.
Yeah, thank you. My views on the optimal structure for a social enterprise really completely depend on the social purpose. So I see optimal structuring as a result of predominantly two things: what the social purpose is and where that fits, and whether it is actually a charitable purpose or not. And that's coupled with how much capital is required and where that's most likely to come from. And that will generally, in an Australian context, drive the structure. So there's no one single optimal structure. That's part of the trickiness in this space, that everything is bespoke, and it needs to be bespoke if we're continuing to preference the social impact over other things.
And I think, to add to that, organisations are presented with a bit of a binary when they're establishing to incorporate not-for-profit or for-profit. And we do see in other jurisdictions, such as the United Kingdom, we have community interest companies and other off-the-shelf hybrid forms. Here, the only route to do so is very complex and convoluted. So, there is the possibility of something like a community interest company as an alternative, but take-up hasn't been huge for those, the social enterprises. It's been more public sector spin-offs and so forth in the UK. So there has been a bit of a push to establish an off-the-shelf hybrid legal form here, but there's not huge evidence on that question at this stage.
Lisa from Westpac Foundation, she said, great insights. In regards to conflicting interests from different partners, are there any examples you can provide info on? Mike, I'll direct this to you first.
In terms of, I might redirect this one to Libby. Okay. In terms of, sorry, can you reframe that?
She's looking for examples in regards to conflicting interests from different partners. Maybe if she wants to elaborate on that, if she's happy.
Yeah, we've seen that particularly in our rich case studies. Really, that's those logics, the conflicting logics manifesting, and that's where we have, and some of the quotes that we put up on the coloured slide, I think really neatly illustrate that conflict. So, a not-for-profit really understanding the world through their preference to, support the communities they work with, versus, say, the financing lens where we see a sort of emphasis on generating returns and so forth.
And part of that, sorry, just to add, sorry, Mike, Were you finished?
Yeah, I was just saying, you want to add.
Part of that probably is just to add that it's partly because when impact investing first emerged in Australia, there was kind of a conflation of social enterprise and impact investment. And the narrative around impact investment was very much around sort of the win-win finance first type model, not the concessionary models. So it kind of set the expectations of investors around that. Since then, we're seeing some more maturation, and you're seeing lots of finance first investors who are starting to acknowledge that there can be a tension, or there is often, particularly in the social enterprise model, a tension between social impact and profitability, and therefore some more impact-led instruments and products are required. So we're starting to see some quite exciting stuff emerge from guys like at the Impact Investing Group, and also you're seeing sort of things like CIFA, who are now very publicly declaring the need for blended finance as a result of these tensions. So we're seeing us moving along in the narrative and how we think about it, but we still think it's really important to acknowledge that these icebergs tend to be what pops up still, because there's an undersupply of the impact-led capital.
Okay, so there's more questions coming through. We won't get to all of them, and some of them are duplicates, so forgive me if I don't ask yours. But one from Rob, thanks for the useful presentation and framing of the iceberg. Can you outline your perspective on what role big end super funds will play in this area going forward, given it has already been established by HESTA and others that such investments are compatible with super fund single purpose member benefits? Libby?
It's probably one a bit more for Mike.
I keep directing to the wrong person.
That's all right. It's you know, because the fiduciary duty of the super fund. So Mike, did you want to?
I think it's a great question, and we are seeing movement. And I think that's where we're seeing that sort of divergence between finance first and impact led investment on the other hand. So, you know, an entity like Super, HESTA, which has, as Libby mentioned, very clear fiduciary obligations to generate returns for its members over the long term. They gravitate to very specific types of deals. These need to be at scale. They are still structured in HESTA's case, I think, entirely by Social Ventures Australia. And they're looking for that kind of win-win segment. So with a social return and a high financial return, or at least a market-related financial return. The segment we're talking about is the underserved segment, and that segment where there's not always appropriate forms of capital available. And as Libby mentioned, particularly towards the middle on the needs of social enterprises, that is simply don't generate those returns. These entities that have, you know, they're there to serve their beneficiaries. They are, you know, they don't generate market returns. So we're seeing that bifurcation, and that's what we're trying to emphasize. And perhaps if we're going to look at this end of the segment, we need to look at it in a different light compared to that sort of win-win segment, which is great, but it's not the whole market, and that's the market that's growing versus the market that's really stagnating in a way. And I guess Libby and I have been around this field for about 10 years, and it's surprising how much that has kind of plateaued. It hasn't grown, while the other segment is clearly growing, the finance first segment.
Okay, a question from Sharon. Do you think the difficulty in accessing intermediaries with the right skills is an issue? The ecosystem is limited in terms of ways to access legal financial expertise. I'm guessing, Libby, I could be wrong.
Yes. I think one of the issues is that in the past, people operating in this space have tended to grow up in commercial finance. So because this is a new and emerging field, we haven't seen people yet professionally growing up in this hybrid space, which is one of the reasons why Mike and I are so passionate about education in this space as well. So there's a tendency, probably because of that, and because of the dominance of the finance logic when we talk about stuff like impact investment, you know, people from more of a social community welfare background tend to be, like, this is a generalization, but tend to be very intimidated by finance and words like investment and impact investment. And at the same time, you see people coming from the finance logics and having worked at merchant banks, etc., who come across fascinated and wanting to contribute, but potentially still bringing what is predominantly a finance lens to these things. So until we sort of get this acknowledgement that this is actually a different universe, it's a different world that has elements of both, and that's what a hybrid is, and different rules apply in this space, then we probably are not going to, you know, that's the trickiness. So in the past, we've tended to see intermediaries and people working in intermediaries that still apply a very strong finance logic. And you saw that in those quotes from the advisor on the slide that I put up before. So there was still an expectation of them. They were very much applying a finance-first logic and not understanding the nuance of a small not-for-profit organisation that had only ever got grant capital before, who didn't even understand or know what the obligations of equity capital might be, and therefore, but it was assumed, well, everyone knows that, don't they? Because people were coming, you know, the intermediary was coming with a finance logic lens as well. So we need people that can, you know, boundary span and, you know, do all that.
All that. Kate had a similar question actually around that. And so I'll ask the question, but what are the risks of those of us on the social side of institutional logic calling for more impact first transactions? Are there enough investors to meet us on our side, or do we just call out and work with these intractable conflicts?
Mike, do you want to go, or are you happy for me to start?
I think excuse me, as Libby mentioned earlier, there is a growing understanding bubbling in the marketplace around the need for more appropriate forms of capital. So it's really just about recognising that that's what's required, using, I guess, assets and balance sheets of, say, charitable trusts in different ways, and being a bit more cognizant of those difficulties. Libby, do you?
I think it's also partly people on the social side not feeling intimidated by meeting in the middle with the finance people, and not assuming that logic is not important to these transactions. It's critically important that the social impact is delivered, but also understanding where they're coming from the social side as well. So not sort of rolling over to, oh, well, I don't know anything about finance, so you guys handle it, or we'll take the capital and then see what we can do with it in those sorts of things as well. It's really important that we start to understand that we do have different sort of lenses on this thing, and we need to understand where the tensions exist and not pretend that they don't exist.
Okay. Stuart, to what degree is there scope for something similar to the small scale offerings? Board, might need him to explain these. Board for Crown funded equity capital, but for debt transactions of less than 100K, funded at a local level for amounts less than 1K, rather than needing strategic advice to structure. Yeah. Stuart, do you mind unmuting and asking that question? I don't quite understand it. Libby and Mike might.
So I work for PCYC, and there are things that we do here that don't require $1 million, whilst it'd be nice in certain ways, but there are little projects that we could get up and running at a community level that are viable from a financial point of view that would, so I'm about to try and start up a little mini nursery at the moment. If I had 40 grand to buy a shed and to get some gear and stuff like that, then if I could get $500 loans from a few people for 3 years, that's non-obligatory returning it, then if we're successful at getting up and run quicker, we can turn it around, and it's not enough money to need to do a large prospectus and get it audited or anything like that. It's just small scale. If it doesn't work, there's no harm, no foul, and if those expectations are made clear, then the effort required to get something like that up and running compared to doing 5 grants, of which you've got success on 2 of them, then, or you've got your crew of people who are happy to, rather than making it donation, if you went, okay, well, if we can get the loan, then we could turn this over 5 times on 5 different projects. So, I mean, that sort of model is existing in the third world at the moment. Does that exist in Australia? Can we do that now?
I mean, I guess there's the sort of crowd equity and other more sort of peer-to-peer models. I'm not particularly an expert in those, but they're kind of, that's what can be described as disintermediation. That's really directing, getting rid of the intermediary and more peer-to-peer based models. And I don't know if someone else has more knowledge of crowd equity, or Libby got anything to say.
Well, I was just thinking it's almost more like a repayable grant. So it's concessionary, you know, still sort of fairly at-risk capital. So there's no sort of structured fund or source, like single pot of money at the moment for that sort of stuff in Australia, or no single pathway for that either. It's quite often the role that philanthropy would normally play, particularly with startup stuff. You're right, you might normally go and apply for grants. It could be that you could pitch to philanthropy, for example, that instead of a grant, you could make it a repayable grant subject. And, you know, again, you start getting this money cycling, and it's a much more systems level, efficient way to go. Usually when stuff's starting though, particularly small stuff and where organisations that haven't done things before, I'm putting my startup hat on now, donation grant capital for small amounts is probably a better fit.
Right. So does it sounds like though that there is a gap in the market though at the moment at that small level to be able to just have a simple, repeatable model of going, well, we've done this like, I don't know, 20 times across the state or across the country, that there's not a lot at risk. It's a clean sort of.
One of the issues is that risk is a subjective term. So people will still require due diligence, even if it's a small amount of money. If, you know, so this, you know, this is part of the issue, that sometimes the transaction costs on that sort of thing, even when it's a small amount of money relative to how much, sometimes is, you know, as complex and as big as when you're asking for $1 million. So that's part of the trick.
So if there was a body that would, if there was a body that was able to, I guess, manage that from a repeatable point. So if there was a, similar to Human Ticks, for example, that's curating all the webinars that are going at the moment, that they can go and do the due diligence and go, okay, cool, all right, you got it in, we understand the transaction, it ticks the boxes, it's now been approved for putting it out there for the thing. But
who funds the due diligence?
Well, that's the thing. It could it be, is there a role to play for having that facilitator to be able to wave things through, I guess, to go, okay, well that.
Yeah. I don't think we can design a fund on the webinar, but yeah, I mean, you know, there's gaps all over the ecosystem. That's all I can say, and particularly our colleagues at Griffith and ourselves and lots of practitioners and CEFA and SBA have been calling out for a long time the real gaps, what, you know, some people are calling the missing middle. I did quite a bit of it when I was at Social Traders for sort of the more concessional finance, irrespective of how it's designed and implemented.
Okay, I think we might move on to the next question. So from Anne, are there sector structures that support the cross-fertilisation of experiences, development of models, as well as enhancing awareness for new potential investors, as well as improvements to the different models? That's a big question. Again, I might need to get Anne to unmute and ask that question. Anne, are you able to do that? Okay, I think I might move on.
No, sorry about that.
Hi, Anne.
I clicked the wrong button. Yeah, it's more about how you actually just raise the profile of these different forms of finance and and social investment. So so that sort of more people might be interested to actually invest, but it's also about building the sector and building these opportunities. So at this point in time, it just seems a bit fragmented. So I just wondered whether there was an industry structure or a sector structure that would be interested or is evolving to actually help inform the public, but also inform the not-for-profit sector about some of these opportunities.
I guess that's sort of the role of intermediaries. We have some great intermediaries in the Australian context, CEFA, SBA and so forth. But what we've actually seen is a bit of, I guess, a stagnation in the growth of intermediaries in Australia over the last decade. So generally there's almost less intermediaries involved in this field than there has been in the past. So that's one of the challenges as well. So there's been a kind of contraction in intermediaries rather than a growth.
There's also the federal government social impact investment task force that's occurring at the moment, where some of these issues are being discussed, and hopefully something will come out of that in terms of, greater networking support and intermediation in some of these spaces. But traditionally, probably the focus, because we haven't called out the icebergs, the focus has been on the finance first segment.
Yeah. Thank you.
I must say, though, that the task force is doing a very good job of highlighting the missing middle.
Is it being fairly well promoted, the task force?
Yes.
Yeah. Thank you.
Thanks, Anne. I think we'll get to one of the last questions now. What needs to happen within the Australian ecosystem to promote the development and growth of social ventures and their investment? The big one. There are lots of these big questions, which is great. Mike, I'll start with you.
Libby, if you can take this one if you like.
Thanks, Mike. That's a massive question. I mean, the question is, we need to understand, so in a way, the social impact investment and social enterprise are two separate fields, and they intersect at points around the issue of capital. So one's supply side, one's demand side, both are emerging fields and emerging ecosystems that have massive gaps everywhere. And generally the gaps, it's fair to say, occur where there's market failure. So helping organisations that can't afford to pay for what it would cost for them to be helped. If everyone's going to get a good financial return on a deal, then there can be some fees that might come out of that. So there's probably needs to be an acknowledgement that social enterprise and to some extent the full extent of social finance has elements of market failure all over it, and that there needs to be support where there is market failure from government to help and establish the market. If there wasn't market failure here, we wouldn't need social impact investment because the finance market would be taking care of it, and we wouldn't need social enterprise because the capital, the supply market would be taking care of it. So we need to acknowledge that this is all about market failures. That's a bit high level question, answer to a very high level question.
I think we might wrap it up there. I thank everyone for their questions and for coming along to participate. We hope you enjoyed it. We'll be sending a survey tomorrow. We'd love for you to complete that. And of course, the recording will come a few weeks later. Thank you also to Libby and Mike. We really appreciated your time and your effort in preparing it. And we'll see you all soon. Thank you.